Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle, U.S. economist at Nasdaq, to discuss how important the consumer is, particularly this year, when it comes to retail earnings and inflation. But Michael, before we get into that, I want to talk about data that we can all relate to, right? You know, as an economist, you're kind of really digging into the nitty gritty, but you pulled up a chart here for us that shows the actual cost factoring inflation in for Thanksgiving dinner, and it's pretty substantial.
Right, so inflation is going to be coming to Thanksgiving this year. We've got estimates showing the average Thanksgiving meal is going to be 14% to 20% more than it was last year. And that's actually really a microcosm of what we've seen in the economy in general this year, where there's higher labor costs playing a role, higher transportation costs, higher input costs. For example, there's shortages of flour due to the war in Ukraine. There was an avian flu outbreak resulting in fewer turkeys. So there's a lot of factors resulting in higher inflation for Thanksgiving meals, but hopefully it can be offset a bit by some Black Friday sales.
Yeah, well, it's interesting because retail sales have still been good in nominal terms, besides the fact that we're dealing with inflation.
Right. So even in the face of inflation, consumers have kept on spending. If you look at nominal retail sales, it's up 30% from January 2020. But if you adjust it for inflation and look at volume terms, retail sales have actually been flat for about the past year and a half or so. So that means consumers have been spending more to buy the same amount of stuff.
And we're seeing it translate into earnings as well, because while it was positive in Q3, if you kind of dig under the hood there, more sectors than not were negative.
Right. So I guess taking a step back and looking at margins, margins have been coming down lately, and you see that that's a difference from what we saw earlier in the pandemic. Because if you recall, early in the pandemic, we had margins. Companies were able to pass on their increased costs and then some to consumers, resulting in record margins. But that was okay. Consumers managed that all right because they had their stimulus checks, they had savings from not going out to restaurants, not traveling. But that's starting to change now. The data is showing that pandemic savings, consumers are running those down, and economists believe it could last another 9 to 12 months, and consumers are spending more on credit cards. So as a result, a survey of retailers is showing that pricing power is back down to 2019 levels, meaning they can't pass on that inflation as easily. And that's not the only headwind that companies are facing. There's still excess inventories, which will require discounting. There's higher interest rates, which will add to debt costs. And of course, wage growth is still elevated, so labor costs are another factor. So all those things combined have resulted in margins coming down lately. And the good news for corporates is that margins are still high by historical standards, but that compression that we've seen in margins have resulted in the slowdown in earnings that we're seeing.
And I did jump ahead, you're right, we did want to cover margins, but let's throw up this chart here where we're taking a look at Q3 earnings growth, because while there was some growth there, we can see more sectors were in the red than there were on the green.
Right, so we're pretty much at the end of Q3 earnings season. Over 95% of S&P 500 firms have reported at this point, and we're on track for just over 2% growth. But that's down from 6% in Q2 and 9% in Q1. And in this quarter, we're only seeing 4 of 11 sectors with positive growth, most of it coming from energy. So if you exclude energy, earnings is actually down 5% for the third quarter. So a lot of companies are already seeing a slowdown. And if you look ahead to Q4, estimates are that earnings will fall 2% in Q4 and then return to weekly positive numbers in the first half of next year. So that kind of suggests that if this holds, earnings won't be providing much of a boost to stocks in the coming quarters.
So Black Friday really might be more important than we have expected, because what happens if the consumer does stall?
Right, so if the consumer stalls, we might see bigger discounts, which will result in some disinflation, which could help the Fed. But if it goes the other way, as some companies have kind of projected, with Walmart and Best Buy and Lowe's all increasing their guidance for Q4, then earnings might not fall as quickly. So that could prevent things like layoffs and the like. So it'll be interesting to see what the data shows.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.